Hey, what's going on, cash flow hackers? It's Chris with Life 180, and this video is going to be a doozy. If you are a life insurance agent selling IUL, or if you're somebody looking to buy IUL, you've probably come across my content, and if you haven't already, it's no secret that I'm a staunch opponent of Index Universal Life. I used to be the director of business development for one of the top IUL companies in the country. I've taken that experience, and I had to leave that job because I just didn't believe in the product anymore because of the things I learned. I realized that the companies were actually misrepresenting what they were doing long term, selling them as something that they're not, and ultimately manipulating people through illicit marketing tactics, being deceptive. And I get a lot of pushback from people telling me, Chris, why would an insurance company do that? Why would they lie to us? And what I'm going to show you in this video is real life proof. I'm going to show illustrations. An in-force illustration, which means the current illustration as it's performed to this day with new projections going forward. And I'm going to show you the original illustration that the person bought 7 years ago and what that illustration projected the policy performing as, right? Because that is what the person bought. And I'm sure that that policy was sold only 7 years ago with these expectations in place. And the person who bought it expected and probably is leaning on this policy to perform to a certain level, right? I think it's one of the dangers of this product is the fact that they don't perform the way that they're sold, and that misrepresentation and that misalignment, the fact that agents are selling them as these conservative elements and these conservative products, I think is wildly misrepresentative. So what I'm going to do in this video is I'm going to share my vibe board. I'm going to share the screen, and we're just going to get into it because I'm going to go through this. Now, what I want to do first and foremost, I got a bunch of slides. You can see down here, down in this region down here, I have 39 slides. What happens is I've got this. I'm going to show you this real quick. I have the original illustration, and I have an in-force illustration. So I have this original illustration, but then I have this entire in-force illustration that's here. I'm not going to go through it. I'm not going to go through it. So what I'm going to do is I don't want to go through this, but I want to show this was the original. This is the in-force illustration of this product. And what I've done is because I don't want to go through each illustration fully, I could. You see down here that there are 34 pages here. As far as if you go down in this, right down there, there are 34 pages. But what I'm going to do is I'm going to go here, and what I did is I took the pages out of the in-force and I overlaid them side by side and put them in sequential order with the original illustration to just show the comparison, because I think that's what matters the most. And I want to show the variables in the way that these products work, in the way that they function, in the way that they flow, in the way that the insurance company uses illicit marketing tactics to be able to sell these. And the challenge is a lot of the agents see it and they feel like, that I've been lying about this stuff. And it's beautiful to be able to show proof in how this all works. So what we can see here, and I'm not going to spend a lot of time on the foundational thing here, but you can see this is prepared on July 11th, 2018, which ironically is my anniversary with my wife. That is July 11th. That's pretty cool. And so we look at this. You can see there's an accelerated benefit rider for healthcare services benefit summary, right? So it gives up to $135,000, maximum monthly benefit of $2,700. Remember the thing with this, though, is this is only as good as the policy must be in force. If the policy lapses, this doesn't exist anymore. And if you're using the policy and the cash value for tax-free income in retirement or any kind of loans or anything of that nature, you also put it at risk, right? So it's important to understand. So let's go forward. This is just explanations. I'm not going to spend a lot of time there. This is, once again, it's just going through key terms, explaining what the policy is. It's not the point I'm trying to go through right here. I'm going to get into the things that absolutely matter. So this is where it starts to get really good. So in the original illustration, remember, the IUL agent who sold this, I guarantee, said that the maximum permitted illustration rate, as it was shown here, is 6.54% with all of these. Now, notice that it says the 30-year historical average. I want everybody to wildly understand this. It says the 30-year historical average. The 30-year historical average of what? It would be the 30-year historical average of the index. That's what it's saying. This is the 30-year historical average of all these indexes given the strategy, whether it's a year-to-year, multi-year, uncapped, whatever, they put in what the 30-year historical average is. But you'll notice that the maximum permitted illustration rate is virtually the same with this one outlier. And the reason that the outlier is a little lower is because of the multiplier, right? And so what happens is the reason that the 6.54 is the same across the board is because regardless of the 30-year historical averages, the one indicator that these all have in common, with the exception of this MSCI, is the fact that they're all S&P 500, okay? And the reason that it remains the same then is because they're just buying call options, right? And so what happens when you're buying call options of the same index, at the end of the day, long term, they're all going to play out to be about the same, so that's about what they can illustrate them at. So over here you can see, all right, this is the minimum and the maximum. You can read this is like over this period of time, they ran all these different scenarios. The minimum performance was that, the maximum performance was that. Okay, that was the potential of the actual, illustration potential. So this is how it was sold. So you can see how an agent would say that the 6.54% is the maximum permitted illustrated rate. This is an uncapped index. We got upside potential, even if it's capped index. Upside potential because the cap is going to be higher. I haven't got to the cap yet. I'll get there in a minute in the next couple pages. But you got upside potential, downside protection. You can make up to, let's say, 13% upside, and you got 0% downside. Sounds really good, right? And so when we take this 13% upside, 0% downside, this is where they're saying all the things with the historical averages. This is how we're going to illustrate it. So it illustrates at these rates. It illustrates at a higher rate. Now, what I want to do, remember, this was 2018 that this policy was designed and sold and purchased. Okay, so this is the original illustration that you are looking at right now. Okay, back in 2018. Now, what I want to do here is take a look at this because on the next, well, before we get to the fact that the next page, the maximum illustration rate, I'm going to show you drop to 5.03% instead of the 6.54%, which is a 24% reduction in how it's able to be illustrated, which is crazy because if this was conservative, right, if you think about it, I was like, well, what happened since then? Maybe the markets just didn't do well, okay? Maybe the markets didn't do well. So I went back and I looked at the averages according to this, according to the illustration. 2018 was obviously not a great year, negative 6.24%, but then we had all these positive years, huge years, right? Huge years, and then you had a negative 19.44 there. At the end of the day, in 2024 year to date, we're having a great year, although the last couple of weeks has been tough, but it's still overall positive. At the end of the day, if I just did 2018 through 2023, and we didn't account for 2024, which is above the average, so it doesn't have a negative impact. If anything, if I included 2024, it'd have more of a positive impact. But the average is 11.76%, even with these two down years, right? That's the average of these returns. And so when we look at that, I go, okay, then we should be beating. We should be beating. We should be capturing this upside potential, whether we did the cap or uncapped indexes. We should have more cash value in this policy because the policy performed, or the market, the index, I should say, performed better than expected. And it is what it is. But the bottom line is, let's go to the current in-force illustration. This is the in-force illustration, and you can see that this one was prepared. I'm going to go down here. This one was prepared on August 13th, 2024, okay? So when we look at that, and we look at the facts, and we look at the fact that the S&P did what I just showed, 11.76% average over that time, yet look at the maximum permitted illustration rate. It went down to 5.03%. So if I go, what was the maximum illustration rate on the previous one? It was 6.54. So if I go, let's see here. I'm going to run some math. So I go 6.54 minus 5.03 equals divided by 6.54. Yeah, that's a 20. Okay, so that's what that was. Okay, that's a 24% reduction. I did that on the other page. This is a 24% reduction in illustration capability, even though the market performed amazingly. And why is that? This is what I always try to tell people, and some people just don't want to see it. I think there's so much confirmation bias and they don't want to see it. The reason this happens is because the index performance, this 30-year historical average, by the way, when we look at the 30-year historical average, I just showed you the 30-year historical average went from we had 11.76 average over the past couple years, okay? 11.76%, but look at this. It went from 8.57 in that one, in the bottom, the uncapped. Look at the uncapped S&P 500, went from 8.57 30-year historical average. 1-year uncapped S&P went to 5.50, even though the average return was 11.76. Why would that be? Because this 30-year historical average, we have to take into consideration when you do a look back, because these indexes, when you do the uncapped indexes, well, I guess this one is actually the S&P 500, but you have to look at the spread charges and how that impacts the actual performance of what it would be, right? And so the craziest thing there is, even though over the past 5-6 years, we've had better performance in real life, the index, because of spread charges and the way it's actually performed in the policy due to the fact that the company has changed these charges, and I'm going to get to that in a moment and show you, and it's all going to make sense, because you're probably thinking, how in the world is this possible? How is it possible? I'm going to go back here again. How is it possible that we had 8.57 historical average and an illustration rate, 6.54? I was sold that this was conservative. We look at the performance of the S&P 500 during this time that I bought this policy, in which case this is, I should be taking part in the greatest bull run of all time, and yet this policy is not performing. And so how could this possibly be? How now am I doing this, and why am I not being told this by my agent that it's not performing this way? The answer is because your agent is not even aware. And now I want to show this. Remember, back when they sold it to you, the maximum performance out of all the tests that they did was 8.27% with the lowest 4.1. Now the maximum is only 6.33 with only 3.32 on the bottom, right? So it's getting worse and worse and worse. So the question is why? The market's been doing well. If I'm supposed to be participating in the S&P 500 and the market's supposed to be so good, why is this happening? If you're with me, if you're like me, you're probably questioning what is going on, right? So you look at these, and you could see that these are all the current when it was sold, what the cap rates were. This is pretty gross, right? You look at the uncapped index, there is no cap rate. You look at the multi-year, you got up to 13% cap on the multi-index. The S&P 500 point to point was 11% on the cap rate, and it guaranteed to never go below 3%. Obviously the uncapped, which is the most common sold thing, they say it's no cap strategy, meaning it's guaranteed. They'll never put a cap on it, okay? So the question is what's the catch, right? That is what people kind of struggle with and they don't understand. So one of the things that I think is important to understand is that this is where they get you. Remember, once again, the maximum illustration rate I showed down here was 6.54%. I'm going to change the laser to red so you can see what I'm doing. It doesn't blend with the green. 6.54%. But here's the deal. With the uncapped index right here, they have what's called a spread charge. Now, the current when it was sold was 5%, and the guaranteed on this is 15%, meaning they could technically raise the spread charge from 5% to 15%. Now, if you're not familiar with what a spread charge is, basically it's saying that is the cost of participating in the uncapped index. What does that mean? That means if you have an investment, or if you are participating in the S&P 500 and the spread charge, I'll just write spread, equals 5%, That means if the S&P 500 equals a 7% return on a year, you have to go 7% minus the 5% spread equals your 2% crediting. Right? So if it was a 10% return, you'd minus 5% and you'd have a 5% credit. Right? So in order for you to get this 6.54% illustrated rate, you need 11.54 minus 5% spread charge equals 6.54. If you don't, you realize we just came through the greatest bull run of all time, and we've basically, I showed you, we've averaged 11.43%, I think it was, over the last 6 years, and that's participating. Granted, we had one, really bad year in there at negative 19%, but overall, these years have been really, really solid. What's crazy is, so I want you to look at this, right? So we have this current is 5%. Here's where the wheels come off, right? Because now we go to the in-force. Look at this. The current in-force illustration is showing the spread charge is 11%. That means the first 11% rate of return in the uncapped index that you have is going to return you 0. That means to get to 6.54%, we need to say, all right, 11 plus 6.54 equals 17.54. That means the market has to average 17.54 for you to be able to get that 6.54% return, because you got to take the 17 minus 6.54 to get to the 11. Does that make sense? I hope. So you can see here now, this is why the maximum permitted illustration rate, even though the market has done well, even though all these things have happened, that this performance is actually going down and down and down inside of this illustration. I try to tell people this all the time, and hopefully this is making sense, that the index that you're quote unquote participating in has nothing to do with your actual policy performance. It has to do with the options budget, which is, the general fund performance effectively, plus options cost. When you take these two things together, that allows them to buy call options, and it creates the whole structure, and then they have to create a price for what the cap rate is, right? Which is, the cap rate has gone down. And when I say a price for the cap, that price, if it's an uncapped index, what is the cap for the participation rate? What is the price for the participation rate? What is the price for the spread charge? What is the price for any of the fees? Now, this doesn't even account, a lot of times there's what's called an NRR, which equals a no risk rate. That, sometimes is on top of it. You got to look fine print on that. I haven't even gone into that on this policy, because it's honestly just bad enough as we're seeing it, right? What is right in front of us is what we're seeing. Now, what I want to do is I'm going to go down here. What page am I on currently? 10? All right, so I want to go down here. I'm going to scroll down to the pages with the ledger, because what's important is to see how this actually impacts the long-term growth and performance of this policy. So what we look at here, I'm going to go back to this. We're at the original illustration from 2019, okay? This is what this person was sold, okay? Remember, we got this 6% illustration assumption, right? On this, he did the multi-index with multiplier is what they did. They put 100% of the allocations into that. 6% was the assumed interest rate. So they didn't even run it at the maximum 6.54%, right? So they would say that they sold this conservatively. And this is what I always try to tell people. These illustration rates are not conservative, y'all. They're just not. At year 10, I just want to focus on year 10 for a minute, because you could see year 1 paying $26.65 a year. They're paying that every single year. At the end of year 10, they paid $26,650 in premium. The net surrender value at the end of year 10 shows $22,444 with a death benefit of $157,820 and that living benefits rider of $135,000. Okay, so that is where we are right now. You put in $26,650. It's not even to point, by the way, this isn't even to point fingers at, whether this is properly designed or improperly designed, because I'll tell you, I know I'm going to get a lot of agents that say this is not an optimized design policy, and I will say and acknowledge right now, this was not an optimally designed policy. But that's irrelevant to the fact that I just showed you that the spread charges and the cap rates were manipulated, right? And so when we look at, when we look at, I want to go back really quick to page 10, because I skipped over one thing. I skipped over, we have the cap rate. Where did the cap rate go, though? Where did the cap rate go? I didn't show the cap rate of the in-force illustration. It went down to 7. I could tell you that. So, and this is crazy. So the cap rate went down to 7. Let me figure out where it is on the page. I got to find it. I'm going to go to my computer right now and Control F, cap rate. Okay, I'm going to go bang, bang, current. Okay, so the multi-year index point to point and is, I gotta insert it. So give me 1 second. I'm going to do this on the fly. And this policy, the index crediting, is this line right here. 11% cap rate, everything was built on that. That's what they put everything into. If they had done the no cap, it would have been uglier because I showed you the increase in the spread charges were what they were. The 11% cap rate here, that was the original illustration that was sold. Now you can see it right here. It's 7.6% currently. So they dropped it from 11 to 7.6. So if I go, let's talk to you about let's figure out what that reduction is in the cap rate. So you go 11 minus 7.6 equals 3.4 divided by 11. That's a 31% reduction. So we had a 31% reduction in cap rate. So here's the deal. Remember, this policy was originally ran with a 6.0% assumption. Now we're talking about the max it can ever receive is 7.6% is the max. So if this is the max you can ever get, 7.6, you have a 0% chance long term of achieving this 6%. So when people like, David McKnight and people like Doug Andrew and Curtis Ray and all these people that sell these things with these current assumptions, this is the problem. I want to really express this right now, and you need to understand this. Like, if you hear nothing else, this is what you need to hear in this video. These life insurance companies utilize cap rates as a marketing expense. They write off the cap rates, the current cap rates, as a marketing expense. This policy was sold. It was an index universal life accumulator. They launch new products, right? So they launch this product, they sell it, they have a 11% cap rate, they sell it, they do what they do, and then what happens is they launch a new product. When they launch a new product, they market the new cap rate. Let's say when they have this product, current product, we'll say it's 11%. They run that thing for, say like 2 years, 2 to 5 years. They'll do that, and then they do a new product. As they launch the new product, maybe the new product is at, let's just call it the same percent, 11%. If everything goes down, it might be a little lower depending on the market, but let's just call, it is what it is. What happens is when they do that, legally and compliantly, they are no longer, because this current product is no longer being sold, so because it's no longer sold, they can drop this cap rate like they did here to 7.6%. All the while, these new products are marketed at higher cap rates, and so nobody's none the wiser. The only way you know is if you check your statements and run in-force illustrations and you check it out. And so what happens is all these people that send me messages like this Angelo guy or whatever, D'Angelo or whatever his name is, that Onion Sports or whatever on YouTube, he's always sending me all these updates like, look, you're wrong, cap rates are going up. Yeah, cap rates are going up on new products. New products only, right? They're not going up on old products. They're going up on new products. Why? Because they're currently trying to sell them. That's all they're trying to do. The cap rates as they're sold right now have nothing to do with what your long-term performances are going to be at. And in fact, what they're marketing, whatever new generation product that they're going to be selling at 11%, has nothing to do with the fact that they're going to be reducing the performance of these old policyholders. And what matters to you most? What they're selling the new products at, or what your policy that you bought to hold for 30 years, 20 years, 50 years, whatever the time frame is for all these benefits that you were sold? That's what matters. That's what matters. And if you know that they're going to reduce this performance and it's going to look like that, well then, you know what? You got to be careful. And this is the problem with this. And I don't know how anybody watches the video that I'm making right now. I don't know how you watch this and actually ethically sell Index Universal Life ever again. And I don't know how you'd be foolish enough to buy an Index Universal Life policy ever again. So now what I want to do is I want to go back here. I think I'm going to get back to the page that I was at. All right, let's go back to this. This is interesting. Okay, now I want to go into detail and show you the actual impact and ramifications. So we're going back to the original illustration. It's at 6%, right? Remember, we're going back 22,444, 157,000 in death benefit, and then you got that rider. And then what it shows, let's go to the next page, which is going to be the in-force illustration. This is currently the one that we ran 8/13/2024. Okay, you can see we're 7 years in. It starts at year 7 because this is showing a projection from this point forward. And now at year 10, it's not so bad because the market has performed well, right? So it hasn't underperformed. But the problem is now moving forward, how much less is this going to actually perform in the long term? Because isn't that what matters once again, right? Like, this is the thing. This is why I always tell people, you're not going to realize you have a problem until it's too late. And a lot of times people are calling me and being like, hey, Chris, you know what? And I did a thing called the IUL Challenge, and they'll look at this and they'll be like somebody would look at this, somebody like Brian Gerald would look at a policy, even though he would argue with the design of this and whatever, but some other illustration would look at this and be like, at year 7, it says 13,158. They're going to look at this and they're going to be like, all right, year 7, I'm at 12,870. Okay, no big deal, right? Like, no big deal. If you look at that, that's only like, I don't know, $300 difference, we'll call it, right? It's only $300 less. So that's like a rounding error, Chris. What's the big deal? Why is this number a big deal? At year 10, we're pretty much on par. We're less than $1,000 off. It's not a big deal. If we go to year 20, if we look at year 20, the new in-force is at 57. Year 20 on, I got to go to the next page because that's where it is. So we're in-force right now. The new projections are 57,000 at year 20. Well, the original projections that they had were 66,000. Ooh, all of a sudden now we have about 10% less money. Okay, so this is like, let's say 9% less in that ballpark, right? The death benefit is 201 on the original, and it's 192 here. Okay, on the current illustration, right? In case you can't tell, the blue, the one that's in color, is the current, right? The original is the black and white. Okay. In case you are getting lost, because I know I'm moving fast. You might have to watch this a couple times to kind of keep up. But here's where it gets really, really ugly, okay? Because why did you buy this policy? You bought it for long term. You didn't buy it for the short term elements of this, right? You bought it for the long term benefits that you're and the problems that you're looking to solve. Is that fair? Right? So when we look at this, I want to go here. I want to take a look. Let's take a look at age 70, okay? At age 70, this policy, the in-force, the one that you bought, the one that you had at that point in time, well, let's just, I guess, look at age 74, just because I had age 70 there, but I want to look at the total premium paid. You put in $93,274. It shows that you'd have a surrender value of $174,000, death benefit of $309. Okay, that's fine. But well, let me do it this way too, because age 70. At age 70, I guess I did the math already. I won't confuse everybody. At age 70, you're going to have $142,000, and you've paid a little less premium, 94 minus this 4 years of 2665. So you got $142,000 of cash value. And then what really happens on the current projection, and by the way, this is just a current projection, right? This is based on the new rules and based on the fact that the cap rate was reduced. Meanwhile, by the way, this policyholder, how would you feel if you were this person when you're looking at this 7.6% cap and you know that Nationwide right now is out there selling 10% caps and raising them for everybody else to sell the new ones? How would you feel about that? Knowing that this policy that you bought that showed you all this hope and promise of like this product solving all these different problems for you, and now all of a sudden you're looking at this and you're like, oh my gosh, in real life, I was told that I was going to have 142,000 at age 70, and all of a sudden now, not even, and by the way, this is not even what you're actually going to have. This is just the new projection, 96,000. Okay, so remember, at this point in time, you've put in 74,965 plus the 2,665, so basically $77,000. After 31 years, you only have $96,000 in cash value. The death benefit's a lot lower. What happens is the cost of insurance now is going to be much higher, and this policy is going to be way less. Your cash value is $45,000 less in the new projections only 7 years later, which is 32% less than the original projected illustration that you were shown. Now, once again, if we go back to this, is why I always tell people, you don't even know you have a problem until it's too late, because what's happening is we go back here, remember, and they go, oh, Chris, at year 10, we're still projected to have $21,318, and right now, the original illustration, we're only $300 off. So they'd look at this and an agent would be like, yeah, see, it's not that bad. Like, you're pretty much on pace. But they don't look at all the other variables that come into the equation that actually lead to the long-term results, which is what matters. Now, this is important, and I want to try to land the plane on this because this is really just super vital. One of the things you'll see here, this is the original illustration, right? This is the one sold back in 2018. I'll zoom it in for you so we can get really clear on these numbers. With the alternate interest rate, which whatever, it lapsed at 86 years old. Okay, with the current assumed rate when it was really originally sold at 6%, there you can see that the surrender value at 89 years old was $236,000 with a $371,000 death benefit, and you still had this benefit for accelerated benefit riders, right? The cash value, starts going down. The death benefit goes down as the cash value goes down, but this policy, you can see at 99 years old, is in force, and it's pretty stable, pretty solid. I would argue there's no income being shown on this illustration. As soon as they were to take income out of this would all blow up and it would all be really ugly. That would be the in-force illustration. That would be my argument if I was like selling against this back in 2018 when the person bought it. But here's the bottom line. Let's take a look at the current in-force illustration with the new assumptions. Now, even with best case kind of current scenario assumptions, which once again, I'm going to tell you right now, it's not going to happen. 89 years old, 90 years old, the policy is lapsed. What does that mean? You're going to have to come out of pocket. You're going to have to come out of pocket to keep this policy in force. And you're talking about a real catastrophe in a lot of people's lives, because you're going to have, there's a really good chance this is life expectancy. This is when they're going to need this benefit for accelerated benefits and to be able to get into a long-term care facility or have assisted living or, that critical care rider component to these things that people want to take advantage of, right? So you got to know that this living benefit rider, this $135,000, is only as good as this policy being enforced. I will make a strong argument based on the information that I've already shown you that those cap rates are going to go down even more, that everything is going to go down even more, and it's going to get worse, and this policy actually lapses more in the 80 to 85 year range right here, not here. It's trending that way already. We have to see how things go, but this is just because they reduced the illustrated rate to 5.03%. But the question is not that. The question is why. It's why I always tell people the index performance has nothing to do, whether it's capped or uncapped. At the end of the day, you're still dealing with the same options budget, the same options cost, and if you're doing apples to apples in the same index like the S&P 500, the performance from a long-term perspective is going to be what it's going to be. And the people that tell you that they can actively manage your money for you in and out and put it into the higher risk things on an uncapped index on, following a down year, and people that say put it into the capped index or fixed index, when you're going into a bad market, I'm sorry, that is more of a strategy that should be left to really high-level money managers, which I promise you, your fixed product licensed life insurance salesperson is not. Basically what they're doing is they're saying, you know what, I'm smarter than the general fund managers making hundreds and hundreds of thousands of dollars a year and a team managing billions of dollars. I'm smarter than them and I can manage your risk better than them. That's what they're saying. Think about the ego in that. And so when we look at this and we look at the way that this thing plays out and the way that this policy ultimately winds up lapsing, and that's pretty much the end of it here. Yep, that's the end of it. And when we look at the way that this policy winds up lapsing and the lack of performance, and to me the biggest thing here and the biggest takeaway is they're going to market whatever they want. Life insurance with Index Universal Life specifically is all about the illustration war. Now, I'm not going to say that that doesn't happen in whole life a little bit too, because it does. It's one of the reasons that I don't sell certain companies that illustrate better than other companies, because just because illustrations show a certain way doesn't mean that they're going to perform that way. You have to look deeper. You have to understand why. And this is, I spend so much of my time trying to educate people and showing people how this stuff works, and you really need to understand it. And this example right here, this is a World Financial Group policy. This is a World Financial Group salesperson. It's designed, and you know, it just is what it is. You know, regardless of World Financial Group or whatever, it's a nationwide policy. Nationwide has been touted for being one of the companies that's increasing its cap rates. Tell it to this policyholder whose cap rate is now 7.6%, which is a 2% reduction from what they originally purchased at. All the while, they're increasing current cap rates just to market, just to be able to sell, just to be able to illustrate better. And guess what? They write those marketing expenses off. They just do. This is the way it works. And so this is one of those things, the proof is in the pudding. Companies do this. It happens all the time. This is happening constantly. If you have an illustration and you're a policyholder and you have, I would encourage you, you need to do this for yourself. You need to, and if you're an agent and you've been in the business more than a couple years, you need to go and run and get the current illustrations, the in-force illustrations, run them for all your clients. Go look at the original illustrations and make sure, and I'm telling you, do the deep dive. You'll see exactly what I'm talking about. This happens across the board in this industry. This is the reason when I discovered this, when I was a director of business development for one of the top IUL companies in the country, when I discovered that this was happening, that was when my moral dilemma kind of kicked up, and I was like, I can't. If this is what's happening, then it's all smoke and mirrors. It's all a lie. Like, I can't be behind this. Yet when I tell people that this is happening, you know, they ask me to prove it. They ask me to prove it, and it's really hard to get somebody to allow me to put their information out there. And so finally, we have this out there, right? And this is just one example. And I would encourage, if anybody out there, if you're a policyholder, I encourage you to get your original illustration, run a current in-force illustration. You can email chris@life180.com. I'm happy to do a similar evaluation for your policy to let you know what your options are for you as well. I can have my team do it, and you know, this is what we do. You can go to rescuemyiul.com. Rescuemyiul.com. The link is down in the description below. You can check that out, and you can make sure that you can upload both of those documents. My team will give it a run through and make sure that you're protected. Make sure that you understand that maybe just because your policy seems like it's kind of on track right now, it doesn't mean long-term that it's going to be. So I hope you found value in that. Hope it adds value to your life and your practice. And before you make the decision of going with an IUL, you actually understand what you're getting involved with and how the moving parts work and how the companies kind of work behind the scenes. Really important to understand. So till next time, have a blessed, inspirational day. If you haven't already, make sure you like, subscribe, hit the bell, that way you're notified every time I launch a new video, because I'm doing these often. All right, we'll see you soon.